Hello, welcome to the Credit Compass, your guide to navigating European credit markets. Each week we unpack the key developments in credit, explore the macroeconomic trends shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. Whether you're a fixed income veteran or just finding your footing, our aim is to make the complex world of credit more transparent and actionable. This week, we will cover unresolved trade issues as supply chains realign. Further, we will outline the accelerating flow of capital into European private credit, given the scale of the opportunity available. Recent proposals for regulatory change in European securitization are a potentially positive development, but a big part remains outstanding. And we will also cover the outlook for the second half that several investors have recently published and how they view positioning for Europe's near-term future. All right, let's get into it. We begin with a rare dose of good news out of Washington. Section 899 of the Big Beautiful Bill, the so-called revenge tax, has been removed. As regular listeners will remember, Section 899 would have allowed the U.S. to levy additional taxes on companies from jurisdictions whose own tax regimes were deemed unfair, effectively targeting countries that adopted the OECD's Pillar 2 minimum tax framework, as well as those that created digital services taxes and other policies that the U.S. deemed targeted at U.S. companies. Last week, Treasury Envoy Scott Bessent secured G7 support to exempt OECD-aligned taxes, and the administration persuaded Canada to shelve its digital services levy. On his recommendation, Congress agreed to strike Section 899. The bill is expected to clear the Senate within days, perhaps even before you hear this podcast. All of this should lift a cloud that had threatened to ensnare European multinationals and investors in yet another tariff-style skirmish. But there is still plenty more on the trade docket. A self-imposed 9th of July deadline for a raft of agreements is fast approaching. Privately, negotiators concede the finish line may slide to late summer. The EU-US deal is reportedly close, with proposals to potentially accept the minimum universal 10% tariff, and then simply seek to lower rates on key sectors, such as steel and the autos. However, Brussels is also hedging its bets. President Ursula von der Leyen has signaled renewed interest in the CPTPP, or the Comprehensive and Progressive Agreement on Trans-Pacific Partnership, hinting that Europe could pivot towards the Pacific. The addition of the EU into the partnership could shift it to become one of the largest centers for international trade. This would ensure a rules-based trade architecture may be reborn, with or without full U.S. engagement. Investment flows continue shifting with or without trade deals. First quarter data shows European private credit funds raised about $31 billion, surpassing the $27 billion gathered in the U.S., a first. The driver is familiar. Banks, constrained by regulatory pressures and balance sheet constraints, have been trimming mid-market lending. Private funds hungry for yield and armed with dry powder are stepping in. Since 2018, European private credit assets have more than doubled to over $500 billion. Growth looks set to continue. The second iteration of the Alternative Investment Fund Managers Directive, or AIFMD2, is to be implemented in 2026. It will grant EU-domiciled funds a lending passport with the ability to originate loans across Europe. This was previously subject to national rules, which were inconsistent and difficult to navigate. Apollo's recent white paper, Europe's Private Credit Moment, underscores the potential. Non-banks still account for just 12% of EU lending, versus roughly 75% in the US. Even closing a fraction of that gap would unleash close to $1 trillion of new capacity. This growth in private credit will be a challenge to the banks, which, as I highlighted in a recent podcast, are struggling to create cross-border champions. Get ready for a potential expansion of mergers. Away from private credit, Brussels has recently issued a consultation on targeted changes to the European securitization regulation. Slimmer disclosure templates, proportionate due diligence, and capital charges that better reflect risk. For issuers, the tweaks promise lower operational costs, and for investors, simpler paperwork and timelier data. There are targeted changes to the prudential framework for banks and insurers to introduce greater risk sensitivity and address the undue overcapitalization of some types of securitization exposures. The anticipated benefits for securitization issuers and investors are the reduction of unnecessary operational costs for all issuers and investors in the areas of reporting requirements and due diligence. Yet one crucial piece is missing. Under Solvency II, insurance companies still faced hefty capital charges on structured finance exposures. That burden pushed insurers' securitization holdings from 8% of bond portfolios in 2010 to just 1.6% by 2023, according to AFME. A recalibration would unlock a deep pool of patient capital. Meanwhile, Brussels is also quietly pruning the ESG rulebook. This isn't a rollback, but a recognition that reporting fatigue was starting to crowd out issuers. Expect more principle-based guidance and fewer prescriptive templates. All good news for smaller issuers who lacked the compliance budgets of blue-chip peers. This policy shift is positive, albeit more of a scaling back of the pipeline and not so much of a cut in the existing regulation. However, the direction of travel hints at a real change in the way that the Commission sets about regulating the continent. Turning to investment managers, a number of them have released their views on the second half of the year. Broadly speaking, of the half dozen or so that we looked at, the consensus expects another 25 to 50 basis points of European Central Bank easing and potentially 2 or more Bank of England trims by the year end. Market pricing currently implies around 35 basis points. The risk to these expectations is more cuts if euro strength drags inflation down too sharply, even though the data out on Tuesday saw a slight tick higher in inflation. The recent euro strength was highlighted as a risk to the region by the European Central Bank Vice President Luis de Guindos in a rare comment about the rate of change in the value of the euro at a meeting of central bankers in Portugal this week. When it comes to Europe, Amundi and Vanguard both see value in European high-yield and investment-grade credit. Managers have migrated into a more neutral stance on the equity side, with Amundi preferring to head down into mid-caps and smaller, with defense companies a particular target still. PIMCO suggests a focus on the front end in European government bonds and a preference for higher quality credit. Fidelity likes the idea of European real estate for yield opportunities, and nearly all of them highlighted the opportunities available in the private credit space, particularly in the infrastructure market. The focus here remains on the energy transition, defense spending, and as inflation hedges with positive yields. Policy tailwinds should continue to support these sectors in the near term. So where does that leave us? Well, we largely share these views. In fact, they are in line with what we have been saying regularly. Europe remains a beneficiary of global capital rotation and looks attractive on a relative value basis. Risks from geopolitics to supply chain upheaval are hardly priced out, so nimbleness and rigorous single-name work are essential. The ride since January has been anything but smooth, and the next quarter is unlikely to be calmer, so flexibility is your friend. We offer our own comments on the outlook for the quarters ahead in our upcoming The Forward Look, so stay tuned. Zooming out, 3 messages dominate this week's Compass reading. First, trade friction, or at least volatility, is easing, but timelines are elastic. Watch the calendar as closely as the communiqué. Second, private credit is potentially Europe's breakout story, moving from fringe to mainstream as regulation morphs from hurdle to tailwind. Third, incremental policy tweaks on securitization, capital rules, and ESG scope are reopening channels of capital that have been partially obstructed. That's all for this edition of the Credit Compass. If you found today's episode helpful, please like, subscribe, and share it with friends and colleagues. If you have a question or a topic you'd like us to cover, then please do get in touch. We'd love to hear from you. And for more in-depth financial research and credit ratings, please visit us at kbra.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.